Mini review for December 18th, 2024. Obviously, I'm doing this on Sunday, but December 18th, 2024 is the day I'll be reviewing. We got a measured move up today. When you get a breakout above what looks like what has been essentially a trading range, a lot of times you're going to get a measured move up, and we got about a measured move up, and that's where we stopped for the day. Additionally, you could say that we got a measured move down of these 3 bars to about the low of the day, which is, a valid argument. It's just not the measured move you'd probably be looking for at that time, but it just goes to show, when you do get a spike, you have to be thinking about getting a measured move in either direction, because that often happens when you get a spike. Bar 1, a bull bar. Something else actually that was interesting was I mentioned yesterday, or the last time I made a review, which was Wednesday, that this was a ledge. And when you get a ledge, there's an 80% chance you're going to go above it and then back below it within, the next day or two. And you can see here, we went above the ledge on the gap, but it's an important magnet. And when you get important magnets and you get gaps through important magnets, you generally have to go test them and oscillate around them a little bit. And so, you can see we got the gap above above Wednesday's ledge, but really, this all just looks like a leg in a trading range, and you don't know where the bottom of the trading range is. And I thought the ledge was a pretty credible spot to expect some profit taking. And you can see we got profit taking here, and then when we tested again, we got profit taking again. So the market was clearly paying attention to the ledge, and we pretty much oscillated. We tested, right on it a couple times on the way down, and then again on the way up, we tested it a couple times. So obviously a very important support and resistance area. So bar 1, a bull bar closing, somewhat near its high, but not all that great. Bad follow through on bar 2. But an outside bar, but not really, not the best outside bar in the world, I don't think. Nothing to really, sorry, I was thinking about something else. Let me restart there. Bar 1, a bull bar closing on its midpoint, not very good. Looks like a trading range. An outside bar on bar 2, but probably buyers below, probably sellers above. And an outside bar again on bar 3. Do you sell 3? It is an OO pattern, but, bar 2, disappointing, and bar 1, really not all that great. So this really just looks like a trading range, so you kind of have to be expecting bad follow through here. And what you get bad follow through on bar 4, and probably buyers not too far below bar 4. And you can see the traders bought it, and that's exactly what we got on bar 5 is, kind of bad follow through. For both sides, really. If you're a bear and you sold 3 and you get 4, you're probably looking for a spot to get out. And that's probably what's happening here on 5, and traders taking profits, and that's causing bar 6. 7 is, I can actually, hold on a second. I'm going to put numbers on all of them. There we go. 6, a reversal up, but you're buying in the middle of a trading range, not that good. A reversal attempt down on 7, but really 1, pullback 2, pullback 3. So it's just 3 pushes down. So I don't really think selling below 7 makes all that much sense. So that's why you probably had more traders buying the close of 7 than selling it, but you just get back to the 6 close where the bulls who bought get out at break even. This is really just, I don't think you need to know all of this, the bulls, they bought here, they bought more lower, they're getting out around break even, etc. You don't necessarily have to know all of that. It's helpful, but as long as you can see that we're in a tight trading range and you shouldn't be trading, that's the important part. 9, a good bar for the bulls, but now you're buying high in a tight trading range. It was potentially a wedge, and this is a reversal attempt up. And then you get bar 10, which is a double top for the bears, and they're trying to make the wedge fail essentially. And they want, essentially a break below the neckline, some sort of measure move down, maybe here. But I think, around yesterday's close, but I think the important target is the ledge. However, 10 doesn't close on its low, so it's really not as good as it could be. 11, a reversal up. I think 11, it's the most credible buy so far on the day. Bears were trying to get a breakout to the downside here, but they failed. And now the Bears have had a couple chances. They had a chance on 3 to break out to the downside, a chance on, 10 to break out to the downside. And it's really not going all that well for them. So I think it's credible buy above 11 for a swing. But, look at the follow through you get on 12. It's not ideal. It's okay to be long still, but it's really obviously not ideal. And then on 13, you can see bulls were more interested in buying, around a 50% pullback during 13 than they were in buying at the market at the close of 12 or buying above anything. So it's not as good as it could be. Outside up on 13, but a big tail on the top and obviously a big tail on the bottom. So, while we are channeling up, it's more of a trading range bar. Breakout attempt on 14, but not closing on its high. Not as good as it could be. 15, tails on both sides, tail on 14, obviously tail on 16 again. So when you look at this, this is actually a really good example of a day where you could look at, a strong trend and then a weak trend. And so look at this rally. You have, tails here, tails here. You can see that the high of 12 overlaps the low of 15. These bars, this bar overlaps the entire prior bar. 16 or 15 overlaps 15, 16 completely overlaps 15. And I would say 15 overlaps 14. So it's really not all that good. Versus look over here, 50, the 50 high and the 52 low don't touch. Obviously, these two lows don't touch. You're getting big, strong bars, and you're getting lots of open, small gaps all the way up. So it's really, you look at this, and you could just see how much stronger this is versus there's just a lack of momentum over here. And when you have, this, you should be thinking that we could have a trend. And when you have this, you should be thinking more, this is probably a leg in a trading range, and we're going to get a reversal down at some point. And, it can happen pretty quickly when you get, in your trading ranges. So that's kind of part of the problem of trading in trading ranges is if you're hoping to get a big move up, you could erase, 1, 2, 3, 4, 6 bars of profit in a bar and a half. And so that's kind of the problem with trading ranges. 17, a bear bar. Bulls, they see 17, and I think if you're long through here, you're holding onto a risky trade. You're hoping it's just going to keep channeling up endlessly, kind of like it did over here, honestly. But you're hoping it's going to just endlessly channel up, or you'll get a surprise breakout. But you also know that the most likely scenario is that you're going to get a reversal down, and so you need to be quick to get out. So when traders see 17, a lot of them flatten at the market, and that causes 18. And then a strong bear bar closing your low on 19, but look, 17, down, up, down on 18, up on 18, down on 19. So it's 3 pushes down, down, up, down, up, down. So 3 pushes down. So, if you're selling down here, you're selling a third push towards the bottom of the trading range. So you have to be kind of careful doing that. The bear argument is that this is a breakout. This is going to become a breakout, and I would agree. It might, but you probably need one more good bear bar here, and you're probably not going to get it since in a trading range, when you need one more bar, you don't usually get it. Inside bar 20, bears who sold for any reason, disappointed at 20, will exit, causing 21, 22. 3 straight bull bars, kind of a surprise. I would have thought that bulls, you knew this was probably strong enough for a second leg up, and this is probably strong enough for a second leg down. So you shouldn't be expecting it to go really too far up or too far down. Just expect a lot of sideways price action, really. And I was a bit surprised that we ended up getting this many straight bull bars. So follow through 23, 24, 25. And, when you get 26, you got to be, that there are bulls who bought up here that are disappointed, obviously, in this, who are going to be looking to sell out of their longs. But you also know that we're getting a breakout of the 18 bar range. And if you get a reversal down within a couple bars of a breakout of the 18 bar range, you're probably, bulls will try to get, or bears will try to get a breakout of the other side, which is exactly what happened here on this double top. So, I would say, it's hard to sell 26 because this is so tight. It's really hard to sell 26. It's also 3 pushes up, 1, 2, 3. So it's a wedge and a higher high double top. But when you get a higher high double top, especially when the second leg up is a climax, which it is about 30% of the time in a double top, when you get the higher high double top, you have to realize that you're probably going to have to get a lower high too. So if you don't want to take the first sell, that's probably okay. You could sell the close of 27 or 28, I think, but if you sell the close of 27, this is probably strong enough for another leg up, so you might have to sit through a pullback. Same thing as selling the close of 28. You're selling right on the moving average, and you have a tail on the bottom of the bar. And I don't know if you're around 50%. You probably are. No, a little past 50%. Maybe if you just do the bull spike. Yeah, something like that. You're still around 50% if you're selling the close of 28, and this was strong enough for another leg up. And then you get that leg up on 29, and then an inside bar on 30. So it's a low 1 breakout pullback from the double top. If you had sold any of these, you'd still be short when you see 30. So okay to take a swing short below 30. And a lot of bears do that, and that's why we get the big dump on 31 down to the other side of the 18 bar range. So failed breakout to the upside of the 18 bar range, and then a breakout to the downside. I actually just noticed this, but it's really rare that you get a breakout to the upside of the 18 bar range, and then a breakout to the downside of the 18 bar range, and then a breakout back to the upside of the 18 bar range. There's only about a 10% chance. Once you break out of the high, and then you break out again at the low, there's maybe a 10% chance that you're going to break out of the high again. So it's really rare. So that's actually a pretty cool thing to see. But it means a lot of trading range price action. You get 31, a huge bear bar closing near its low, and at this point we're probably getting to the ledge. So why do we get a bar like 32? If everyone knows we're getting to this ledge, then why do we get a bull bar on 32? because traders are going to take partial profits because this is such a large bar. If you think about it, if you're selling below 31, trying to get to the ledge, you're trying to make 4 points and you're risking probably 12, 13 points. So you're really bad risk reward. So it's not the best to sell in the world below 31, especially if you're looking to scalp. And that's why you get bad follow through. A lot of the traders would be scaling in on 32. So it's kind of a difficult trade to take. 33 touches the ledge, and we end up finding some buyers there. So it ends up being a doji bar. This is just classic trading range price action. I think traders, they sell here, they're disappointed here. But they'll maybe scale in and then they get out all down here, but probably sellers above 33 during 34, and then low one short 34. Not all that great. There's just a couple of doji bars. It's still always in short, but these are just doji bars. It's really not excellent. 35, bad follow through on 34 and a reversal up on 36, but not all that good. It is a double bottom with 32, but this is just very sideways. And then a breakout to the downside on 37, but you're trying to get a breakout below a tight trading range. This could be a final flag for the bears. If you just look at this, you see, especially, I'll say this after I see bar 38. So you get bar 38, right? I think 38 is too big to buy because if you're buying in, the upper middle part of a tight trading range. So I don't really want to buy here because I think it's the middle of a tight trading range. But I don't really want to sell 38 either because we could easily bounce for a leg or two. And you have to kind of be looking at it at this point and say, okay, is this, what does this look like? Does this look like a bear trend or a bear leg in what's probably going to be a trading range? I would say that this probably looks like a bear leg in what's most likely going to end up being a trading range. So the bears who took the sell or who sold anywhere in here, they're seeing, not the best bull bar, but a good bull bar here. And I think the even more important part is that you got these bull micro channels that are pretty strong early in the day. They're not strong like bull trend strong, but they're strong enough to make me think this is not a bear trend. So when I see this stuff, I start thinking this probably is not a bear trend, and you get such a strong close on 38. You got to be thinking, well, this is actually probably a trading range, not a bear trend. And 38 is too big, and when you see it, you can see bulls more interested in buying the 50% pullback of bar 38 rather than buying above it, and that's why you get 39 traders buying at 50% pullback. Buying at 50% pullbacks was kind of it's a difficult concept, but eventually, just look for bars where traders buy the 50% pullbacks. It's okay to see it in hindsight, but when you see them in hindsight, just try to understand why they're buying, a pullback rather than buying above the bar, and you'll slowly, start to see it better in hindsight, and then eventually you'll be able to see it in real time. 39, a bull bar, it's follow through for the bulls, but it's really not all that good. They wanted a better bar. 40, more follow through for the bulls, but again, if you bought above 38, you're trading against a huge bear bar and a generally tight bear channel. So you're hoping for another bar that essentially looks exactly like 38, if not a little bigger, if you're buying above it, and you get 39. If you're buying close to 39, again, you want a huge bull bar, and you just don't get it on 40, and so traders exit at the market, causing 41. So 41 is bulls giving up, and when you get a bull give up bar, some bears might take the sell below 41, follow through 42, 43. 44, a reversal up, you could argue 1, 2, 3. I thought 44 might be a credible buy if it triggered, since it's a wedge down. And again, this looks like a trading range. And we're probably going to get back to the 40 low since bull limit orders bought there. And they should be able to get out around break even since this is probably a trading range. So if you're essentially betting against a trading range, looking to buy above 44, betting against a bear trend, looking to buy above 44. Bad follow through 45. You can see sellers above during 46. Traders still more interested in buying pullbacks. 47, 48 dojis. So we have 3 straight dojis. So, if you think about it, it's a final flag, right? So you could have argued this was a final flag and we got to break up below the final flag and now we're coming back. But I thought this was a more credible tight trading range and a potential final flag. And you can buy above 49 for a swing, betting that this is probably a trading range and we should at least get back to the open of the day or the midpoint of the day. But I think, probably better to wait for follow through on 50. My only concern was that this was a really tight trading range. I thought we might get pulled back into it. But with the overall context being that this is probably a trading range day, it's probably okay to just take the buy above 49 directly. Follow through on 50, buy the close 50, buy the close 51, 52, 53, inside bar 54, but we never traded below. And then again, look at how strong this channel is compared to this particularly, even this, but the context I think was bad. Was the main problem here why this wasn't doing very well, because this was so strong and it made it likely this was just a second leg up from this, and this wasn't going to go very far on its own because of how strong this was. But just look at all the overlap here versus just very little to no overlap here. Lots of buy the close bars. You can buy the close of any of these bars, put it, trailing a stop. I would start out with a stop below here, and then I would say once you get, I don't know, maybe like 53, I'd probably put my stop down here and just watch it closely. And then when you get the breakout above 54, your stop probably goes below 54 or below 53. You're already 52 is the bottom of the channel, so you got to break out above the channel on 55. Maybe your stop below 55. But point being, it shouldn't trade back down here too far. You want to trap the bears who sold above 54, which is exactly what traders were able to do, proving further that this was a strong trend. And that makes 56, 57, 58 all buy the close bars. 58 broke out of the high of the day and initially failed and pulled back and then succeeded in the second time. Sometimes, when you get a breakout, if you're long and you get a breakout, the breakout will pull back, but it ends up being okay and going. So you have to learn to see, breakout pullbacks versus what are probably going to end up being reversals or, tops of trading ranges that are going to fail. And again, a lot of times you get a breakout above and you're going to go for a measured move. Why? Because traders are buying, the new high, putting with a wide stop, go with a 1-to-1 risk reward. So maybe 60% chance you're going to get the measured move up, especially with how strong all of this was. So huge breakout bar, 59, follow through 60. It's okay to be long up here, but this is a really climactic bar, pretty deep in a tight channel. So I'm not so sure it's all that great. Inside bar, 60. You can buy any of these. They're all by the close bars, but you're getting pretty, it's pretty dangerous. 61, some traders might exit below 61 if it triggers, but it doesn't. Inside bar 62. I think most traders won't exit below 62, but some definitely will. You have at this point a 14 bar micro channel, so you know that the first reversal down is probably going to fail. And you get a reversal attempt down on 63, but it's really not going to go very far because you have a 14 bar micro channel. This reversal is probably minor at best. And you can see on 64, all it did was it allowed limit order bears who sold above the high of the day and scaled in higher. They were able to make money on 64. And that's important because, now we're in the channel phase and limit order bears know they're probably going to be able to start selling above things like over here and making money. But it's still important that they were able to make money here. Do you buy above 64? I think you can buy above 64. I think, if you exit below 63, you probably have to buy again above 64. If you got out somewhere up here as an always in bull, and you were quick and got out up here, then you can probably you could sit up the channel if you wanted to, but you can buy again above 64. But I think about if you exit below 63, what were you scared of? You were scared of another giant bear bar. You were scared of a bar like 19, and then you're going to get trapped, and we're going to head back down here. But instead, you get the bad follow through 64. So I think if you're a bull and you exit below 63, you probably got to buy again above 64. Follow through for the bulls on 65, but a tail on the top. II 66, 67, potential final flag, and a breakout above the final flag on 68, but bad follow through. Bears selling above, scaling in, probably going to make money. And we're just in the channel phase at this point. So spike channel trading range, you can see we broke the channel line on 74 and 75, high one buy, but it's a couple pushes up. Bulls hoping, to get big follow through, but you can see they ended up scalping with, I don't know how many points, a little over, I would say 5 was reasonable. And then we get a pullback and we're probably forming a trading range. For stop orders on the day, I thought 30 was okay. And then pretty much just buy the close anywhere in here. You probably could have bought 11 or somewhere up here, but this is so risky. It's very dangerous to be long up here. It's kind of dangerous to be long up here too. So I thought 30 was good. I thought, that these were all okay. And this is a give up bar, so I guess technically you could probably sell it, but for another leg down from 30, 31. But I thought that these were the best trades of the day. Just buy the close anywhere in here. On the daily chart, obviously, I'm doing this review a couple days late, but I would say if I saw, in general, if I saw a bar like this, bulls were hoping that this double bottom is going to hold and that we're going to get a strong breakout above the neckline, which is what ended up happening. This is not the most likely scenario, though. I thought a more likely scenario once you got this is that you're going to get a disappointing bar, kind of like we rallied up here and found disappointment. I thought that it was more likely we were going to get more disappointment here. But obviously, we ended up getting the strong rally to a new high. So that is pretty much that is the day on that. I might do a review for Friday in a minute.